Welcome back to Journey to Financial Freedom. In our last video, we explored the basics of investing, what it is, and why it matters. Today, we're diving deeper into the factors that shape markets and influence investment decisions. Before we begin, let me be clear, this video is for educational purposes only. It is not financial or investment advice. Always conduct your own research or consult with a licensed financial advisor before making financial decisions. Now, let's talk about economic signals, the big picture indicators that guide market behavior. Whether it's inflation, interest rates, or GDP growth, understanding these signals can help you make informed decisions about your financial journey. Inflation is the rate at which prices for goods and services rise over time. While moderate inflation is normal in a growing economy, high inflation reduces the purchasing power of money. For example, if inflation is 5%, what costs $100 today will cost $105 next year. Over time, this can erode the value of money sitting idle in a savings account. From an investment perspective, certain assets tend to perform better during inflationary periods. Historically, commodities like gold and real estate have been viewed as hedges against inflation. However, investing in these assets involves risks, so it's crucial to understand your financial goals and risk tolerance. This is not advice to buy gold or real estate, but a historical observation to help you understand how inflation impacts markets. Interest rates represent the cost of borrowing money. Low interest rates can stimulate economic growth by making borrowing cheaper for companies and individuals. Conversely, high rates can slow growth by increasing borrowing costs. For example, during periods of low interest rates, companies may expand more aggressively, boosting their profits and potentially benefiting their stock prices. However, when rates rise, borrowing becomes more expensive, which can slow economic activity and impact market performance. Understanding interest rates helps you see how they interact with sectors like real estate, consumer goods, or technology. But remember, this is not financial advice. Always consider your unique financial situation and consult a professional when needed. GDP, or Gross Domestic Product, measures the total value of goods and services produced in a country. Strong GDP growth often signals a healthy economy, which can be favorable for investments. For example, when GDP grows, sectors like technology and retail often thrive. Conversely, during slow GDP growth or recessions, defensive sectors like healthcare and utilities may be more stable. Again, this is not a recommendation to buy or sell anything. The goal here is to give you the tools to understand how GDP trends influence various markets. No single signal tells the full story. Inflation, interest rates, and GDP are interconnected. For example, rising inflation might lead to higher interest rates, which could slow GDP growth. These interactions create opportunities and risks, but they require careful analysis. The key takeaway is to stay informed. Read economic reports, follow credible financial news outlets, and seek professional guidance if you're unsure about how these factors affect your investments. Let me remind you, this video is for educational purposes only. It's not a substitute for personalized financial advice. Always do your own research or consult with a licensed professional before making any financial decisions. If you want to apply what you've learned, here are a few practical steps. Read reports like the Consumer Price Index, CPI, to monitor inflation trends. Follow central bank announcements for insights on interest rate policies. Track GDP data to understand where the economy might be headed. These steps won't make you an expert overnight, but they will help you build a foundation for understanding the markets. Economic signals are like road signs on your journey to financial freedom. By understanding inflation, interest rates, and GDP, you'll be better equipped to navigate the markets. In our next video, we'll explore market psychology, how to stay calm during downturns and turn fear into opportunity. Don't forget to like, subscribe, and leave a comment below. What economic signal do you find most interesting? Let me know, and I'll cover it in a future video. See you in the next step of your journey to financial freedom.